Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Qinfa Group Limited annual report. China Qinfa Group Limited is a diversified investment holding company with a wide range of businesses and services. At its core, the company engages in coal-related activities such as mining, purchasing, selling, filtering, storing, and blending coal in China and Indonesia. In addition to coal operations, China Qinfa Group Limited also provides transportation and logistics services, including goods transportation and charter hire activities. The company's portfolio also includes the sale of machines and machine materials, as well as machine repairing services. Furthermore, it operates a shipping transportation business, facilitating the movement of goods across various regions. With its extensive range of businesses, China Qinfa Group Limited has established itself as a significant player in the industry, with operations spanning multiple countries and sectors. China Qinfa Group Limited maintains a market capitalization of $8 billion, broadly in line with the industry peer group. China Qinfa Group Limited trades at a higher price-to-earnings ratio of 101 times and a higher price-to-book ratio of 3.49 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 60% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. The share count has increased while revenue and shareholder equity are declining. This indicates that management has not yet proven the business model is sustainable. This makes the investment case highly unfavorable. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be summarized into several key factors. Revenue growth drivers. Revenue growth is primarily driven by increased coal trading volume and production in Indonesia, as well as the acquisition of PT Trisula Sumber Energy. The company's ability to increase its commercial coal quality and sales revenue through the operation of washing systems has also contributed to revenue growth. Additionally, significant improvements in production capacity at each coal mine have led to increased revenue. Furthermore, the company's strategic partnerships, such as the coal supply agreement with Zhejiang Energy Asia Pacific, have provided a stable source of revenue. The official commencement of production at SDE Mine 2 and the rapid increase in production have also contributed to revenue growth. Revenue decline drivers. On the other hand, revenue decline is primarily driven by market price adjustments that led to decreased average coal selling prices. The disposal of Perpetual Goodluck Limited and its subsidiaries has also resulted in a decrease in revenue from discontinued operations. Damage to property and equipment has increased operating costs and equipment depreciation, leading to further revenue decline. The loss of control over Perpetual and its subsidiaries due to the disposal transaction has also contributed to revenue decline. Additionally, market signal uncertainties, limited availability of green products and services, and customer preferences for low climate impact alternatives have all led to a decrease in revenue from contracts with customers. The net income of the company experienced a significant decline, with a decrease of RMB 83,990 and RMB 34,907,000. This downturn was largely attributed to reduced demand for traditional coal-related goods and services. As a result, the company's profit margins also suffered. In terms of profit margins, there were notable decreases across various categories. For continuing operations, the margin dropped from 29.9% to 25.7%, primarily due to a decrease in average selling price of thermal coal and an increase in raw coal production volume. Discontinued operations saw their profit margins decline even more sharply, from 15.6% to 4.4%. Overall, the net profit margin decreased from 7.2% in 2024 to 6.8% in 2025. The decrease in profit margins can be attributed to a combination of factors, including reduced demand and lower average selling prices for thermal coal. These changes had a direct impact on the company's bottom line, resulting in decreased net income and profit margins. The company's financial performance is a key indicator of its overall health. One crucial aspect to examine is the generation of positive operating cash flow. According to the provided data, the company has successfully achieved this milestone. In 2025, the company generated RMB 665,740 in cash from operations and RMB 518,029 in net cash from operating activities. This indicates a strong ability to generate cash from its core business operations. Similarly, in 2024, the company generated RMB 921,145 in cash from operations and RMB 466,928 in net cash from operating activities. These figures demonstrate that the company is capable of producing positive operating cash flow, which is essential for sustaining its growth and meeting its financial obligations. This achievement suggests a high level of operational efficiency and effective management of resources. The company's debt level has undergone significant fluctuations over the past year. Initially, total borrowings increased by 56.3% from RMB 1,184,490 to RMB 1,857,091. However, by the end of 2025, this figure had decreased to RMB 2,007,330. Furthermore, non-current liabilities, specifically a loan from the disposal group, increased substantially from RMB 0 to RMB 412,145. In contrast, interest expenses have shown a mixed trend. Initially, they decreased significantly by 91,222 RMB 0 in 2025 compared to 2024. However, on another page, it is mentioned that interest expenses increased by RMB 19,872 from RMB 14,557 to RMB 34,429. The effective interest rates for both fixed and variable rate net borrowings have also been provided, ranging from 0.5% to 5.8%. The performance of various regions and segments has been a mixed bag. On the positive side, mainland China has seen an increase in revenue, rising from 1,464 in 2024 to 1,532 in 2025. Indonesia has also performed well due to its substantial non-current assets and majority of revenues coming from external customers attributed to Indonesia. Similarly, China PRC has done well, with significant revenues generated from external customers. However, the picture is not as rosy for all regions and segments. Overseas operations have seen a decline in revenue, dropping from 224 in 2024 to 433 in 2025. Furthermore, the total reportable segment's revenue has also decreased, falling from RMB 4,664,198 in 2024 to RMB 3,110,536 in 2025. These figures indicate that some regions and segments are struggling to maintain their revenue levels, highlighting areas of concern for the company's overall performance. Management is projecting a promising future for the company, with plans to evolve into a prominent energy group through enhanced customer service, sustainable growth, and strategic competitiveness. The group acknowledges climate change as a critical issue that will impact business operations and financial performance in both short-term and long-term perspectives. To mitigate these impacts, the company is investing in green technologies and reducing emissions and pollution. Management sees opportunities for sustainability and growth in transitioning to low-emission technologies, and is actively exploring an internal carbon pricing mechanism to support this transition. The company's strategy involves diversifying its operations across coal sales, mining, and investment holding in the PRC, while also prioritizing community investments and sponsorships that align with social performance objectives. Management is committed to upskilling technical staff to adapt to climate-driven technological changes and emerging low-carbon innovations. Overall, management's outlook emphasizes a commitment to sustainability, growth, and competitiveness, with a focus on reducing environmental impacts and promoting low-carbon economy transition. The company's strategic moves through acquisitions and divestitures have been significant. In terms of acquisitions, one notable instance is mentioned in page 103, where mergers and acquisitions are highlighted as a key activity. On the other hand, the company has also engaged in divestitures to optimize its operations and financials. One such instance is the disposal group's banking facilities, obtained from 3 domestic banks in an aggregate amount of RMB 417 million, as mentioned on page 26. Additionally, the pledge of shares by the controlling shareholder was fully released, allowing for greater flexibility in the company's capital structure. Furthermore, the company has made portfolio adjustments to streamline its operations and focus on core business areas. These divestitures demonstrate the company's commitment to strategic decision-making and adaptability in a rapidly changing market. The company has a history of paying dividends to its shareholders. In 2024, the company declared 2 types of dividends, special and final. The special dividend was HKD 0.02 per share for 46,938 shares, while the final dividend was also HKD 0.02 per share, but for 46,280 shares. This indicates that the company has a consistent policy of distributing profits to its shareholders through dividend payments. Furthermore, the provision for dividends to non-controlling shareholders in 2024 was RMB 513 million, which suggests that the company is committed to paying out a significant portion of its earnings to its minority stakeholders. Overall, this demonstrates the company's focus on returning value to its shareholders and maintaining a strong dividend policy. Concerns about inventory buildup or supply chain disruption. The possibility of inventory buildup or supply chain disruption is a pressing concern in various sectors. One potential trigger for such disruptions is the uncertainty in market signals, which can lead to abrupt shifts in energy expenses due to volatile coal demand forecasts and fluctuating raw material prices, page 146. Rising mean temperatures, heat waves, and extreme hot days also elevate the risk of supply chain disruptions, page 149. Furthermore, specific companies have raised concerns about potential inventory buildup or supply chain disruption. For instance, China Qinfa Logistics Co. Limited has experienced a significant increase in coal sales in the PRC, which may indicate potential supply chain disruption or inventory buildup concerns, page 301. Additionally, PT Sumberdaya Energy's coal mining and operation in Indonesia have seen a substantial increase in registered capital, which could also contribute to these concerns. Overall, while there are various factors at play, the possibility of inventory buildup or supply chain disruption cannot be ignored. It is essential for companies and stakeholders to closely monitor market trends and take proactive measures to mitigate potential risks. That concludes the financial summary for China Qinfa Group Limited. Feel free to comment below, and I will be happy to answer them when possible.